They promised Britain a neat solution to a messy problem. Swap mountains of government IOUs for a slice of a new trading empire, and everyone would win. For one feverish year in 1720, the idea became a religion. Ordinary shopkeepers, retired sailors, noblemen, and the brightest minds in Europe rushed into a market that promised future riches beyond imagination. What could go so wrong that a city of ledgers and polite coffee houses would end in ruined estates, public scandals, and a lesson nobody wanted to learn? London in the 1710s smelled of salt, ink, and paper credit. The war with France had left the government burdened by debt and desperate for a way to manage its obligations without crippling taxes. The South Sea Company, created in 1711, was supposed to be half trade company and half financial engineer. It offered to take on a large slice of the government's floating debt in exchange for company shares, a swap that promised to convert shaky annuities into tradable equity and to reduce the state's cash burden. That swap, when combined with a monopoly right to trade with Spanish South America, was the quiet arithmetic that would explode into public mania. The deal was deceptively simple on paper. The company would assume government debt, then issue new shares and use the proceeds to pay interest. Promoters painted a world of caravels arriving from the South Seas laden with silver and tropical goods, and this exotic promise was repeated in coffee houses, broadsheet songs, and polite conversation. Behind the scenes, the machinery was less honorable. Company insiders negotiated in secret with ministers, and they offered stock to key politicians and clerks to secure the legislation and goodwill they needed. The market was then lubricated by credit. Loans were made on the security of newly issued shares, and agents were paid to prop prices upward. In months, the share price detached from any plausible stream of trade revenue and began to live on its own momentum. From early 1720 into the summer, price charts, had they existed then, would have looked like a rocket plotted in ink. Shares issued at modest levels leapt to astonishing heights, turning modest sums into perceived fortunes overnight. Cornhill and Change Alley filled with people who never before held a share certificate. Playful songs turned into desperate credit requests. Even the learned and the cautious joined the stampede. The mathematician Isaac Newton reportedly made a handsome profit early, then reinvested and suffered losses so crushing that he admitted he could predict the motion of the heavens, but not the madness of men. What it felt like was not numbers on a page, so it was air itself, feeding on its own breath. What might a single overheated rumor do to the savings of a widow living on a clerk's pension? If you've watched this far, don't forget to subscribe and support the channel. It helps us keep bringing these hidden financial stories from history back to life. When the company could no longer sustain the pretense that rising prices were backed by rising profits, panic began to find the exits. Shares that had traded at a multiple of their plausible value started to move the other way. Margin loans were called in, goldsmiths and banks found their balance sheets exposed, and the public scramble to redeem notes for cash created a liquidity crisis. Within months, the market collapsed. Prices slashed to a fraction of their peak, and the rhetoric that had once clothed the scheme in legitimate commerce snapped away. The scene was brutal and intimate. Auctions where portraits of household heads were sold to satisfy debts, petitions from ruined provincial investors, and coffee houses that had been centers of rumor now echoing empty conversations. How do you restore order when trust itself has been spent? Parliament could not ignore a collapse that had reached into the highest ranks of power. A formal investigation exposed widespread corruption. Ministers and senior officials had accepted stock and secret payments in exchange for facilitating the company's schemes. The Chancellor of the Exchequer, John Isleby, resigned and was later found guilty of corruption. Others were impeached, and some lives and careers were ruined or ended in disgrace. The state attempted to soften the blow, confiscating illicit gains to reimburse victims and restructuring the company's obligations. But the immediate political result was a deep erosion of public faith in both markets and government. The spectacle forced a rethinking of the relationship between public finance and private profit. This was not an abstract failure of models or numbers. It was ruined shopkeepers in provincial towns who had given up their savings, clerks who had borrowed against future wages, and country gentry who saw land pass into strangers' hands. Pamphlets and satirical prints turned the brokers and ministers into grotesque caricatures, and the cultural memory hardened into a cautionary tale about greed and gullibility. At the same time, some of the company's defenders argued that the government needed tools to manage debt, and that financial innovation, however messy, was essential for a modern state. Which of these truths carries more weight when the breadline forms and the ledgers run empty? If you strip away the scandal and the personalities, the core lesson is about leverage, liquidity, and belief. The South Sea scheme turned public debt into tradable assets and then used those assets to create further credit. That loop can fuel growth in good times, but it multiplies losses when sentiment reverses. The mechanics are the same as later bubbles. Promise future returns large enough to justify taking on bigger debt today and keep the machine running by issuing fresh claims on those imagined returns. When reality fails to arrive, the claimants find they are holders of paper without an anchor. Does this sound familiar to any modern market? The South Sea bubble is not an antique curiosity. It is the template for how credit and narrative can create markets that become less about underlying value and more about collective belief. From the Mississippi bubble in France the same year, to 19th century railway mania, to 2000s dot-com excesses, to more recent crypto frenzies, the pattern repeats. New promises, easy credit, political entanglements, and a sharp public reckoning. The question the South Sea episode leaves us with is not whether markets will be irrational, but what institutions and habits we build to limit the damage when they are. Who pays when belief evaporates, and who is held to account? History gives us two harsh facts. First, financial innovation often precedes scandal. It expands what is possible and exposes what is unregulated. Second, the human heart remains the same across centuries. Pride, fear, envy, and hope still drive choices that numbers alone cannot restrain. The South Sea bubble is a ruinous spectacle because its victims were not faceless market metrics. They were families, careers, and the fragile reputations that hold a republic's financial life together. If empires are built on credit, they can also be undone by the same credit when oversight is weak and incentives are corrupt. Which future will we choose? A repetition of the spectacle or systems that remember the cost of believing too much? If this story shifted how you look at the market's headlines, remember the small, stubborn fact that bubbles are not only about prices, they are about promises and about who is trusted to keep them. If you want more narratives that walk the line between money and power, join us. Subscribe, and let's follow the threads history leaves behind, from a coffee house in 1720 to the exchanges of today, and see what they say about who we were, who we are, and who we might let our money make us.